Dornbusch download number 101. Andrew and my friend Michael.
Good morning, Andrew.
Dowie. First of all, thanks for everyone for their kind comments around Dornbusch download 100. Dorney's not too big on Facebook or Twitter or anything like that, so I've been haven't been printing them off. He does have an iPad. He has been looking at it, but he's not one to respond. But he just wanted to say thanks very much for all the kind comments, and we might actually do a couple more of those. Just maybe even talking about your background or Dan's, or we'll get Cyclone Goulson back in, because certainly the feedback is people are interested in sort of hearing how, our experiences, our background, all that type of stuff. So.
It was great to get some insight how they did it in the good old days.
The olden days.
So I know, but this industry's come a long way. No need to tell you, of course, Andrew. But yes, it'd be it's just inconceivable to think back that far and just the way it used to be done compared to click of a button and how it's all done now. So
even Heather, who's here helping us with the filming, who's got no financial markets experience, with all due respect, is just sitting here shaking her head. Some of the things around government setting brokerage, and if you could get a trade done in the day, you were a hero. Whereas if we don't get it done in like 5 seconds, people are up us. It's been an amazing journey.
Absolutely. Now I remember going to the Brisbane Stock Exchange when it was there, and of course the old chalkies up on the board. So it would have been good to sit in on a couple of those sessions. But we've come a long way. Thank goodness.
I used to lecture for the ASX, and they have the lecture series in that room there. And on the last day, whatever the last day was, 1987 or something like that, doesn't coincide with the crash. They've actually left it. So basically, all the chalk marks from 30-something years ago are still up there, and some of the names you don't recognise anymore, Quintex and Bond Holdings and some of the scary ones. But like Elders was one of the bigger companies. It's if you ever get a chance, go into the stock exchange. It's not there anymore per se, but I think they've still got that little trading pit open. It's well worth a bit of a look. Anyway, let's get on with the show.
Trip down memory lane.
Let's get on with the show, so to speak. And August is always an interesting time of year for us because it's profit reporting season. Today we had Commonwealth Bank come out with their half-year results. Was it full year?
Full year
results, sorry. Half-yearly update. So what were the highlights there, Michael?
Yeah, look, big numbers, Andrew, as expected. Market, from what I read, market was looking for about 9.6, a little bit under. It came in at 9.45 billion.
After tax.
After tax, cash earnings. So, pretty good numbers. Shareholders will get their $2.22 per share dividend.
Is that up or the same?
I think it was the same, I'm pretty sure. But again, it was basically what the market expected there as well. Interestingly, Andrew, and I guess no real surprise, impairments were up 27%, I think, to 1.26 billion. And again, due to the slowdown in resources, mining, etc. But market seemed pretty happy with the numbers. I think they were up 20-30 cents around the high 78, something like that. So all in all, some of the bank numbers have been okay. The ANZ trading update from yesterday, Bendigo's result from Monday. Again, at face value, didn't look great, but market seemed to like it, and we've seen Bendigo and ANZ both sort of kick up a bit in the last couple of days.
And I think that's partly because they didn't cut dividends, and that was my question. I've been in meetings all morning, so I haven't checked, but that was my key question: if they cut the dividends. But interesting, like ANZ, you spoke about their quarterly update. They cut their dividend 3 months ago, and the share price went up 10%.
Yes.
Go figure. And I think that's partly because there is concern around sustainability of dividends. Take NAB, and I think NAB comes out with their quarterly update soon, so tomorrow. They're paying out over 90% of their earnings as a dividend. So as a shareholder, getting 7.5% fully franked, happy days. But the question becomes, if they also start increasing their provisions for bad debts, like ANZ, like you said, CBA have, is that sustainable? And I think, from a smell test point of view, it's not sustainable.
Yeah, no, agreed, Andrew. I think, and again, Bendigo actually did raise their dividend by just a solitary cent, but all in all, it's a raise still. But it's hard to see banks still being able to maintain these dividends at these levels, considering the state of play and certainly the outlook for the next 6 months or so.
And finally, on banks, before we talk about a couple of the other profit results, it was interesting interesting to see ANZ start to pivot away or change away from institutional lending, and as you spoke about, there's been sort of some blow-ups in that space. Dick Smith immediately comes to mind, Arium. But, starting to focus on small to medium business and also the consumer. So, short term, that's probably a good thing, but again, you can't help but think with interest rates coming down, and again the RBA cutting rates last week, that focus short term will be good for them from a margin point of view, but won't maybe even potentially further increase their bad and doubtful debts exposure in 2 to 3 years' time. So again, just need to be a bit wary on the banks. We also saw profit reporting results from realestate.com, which is sort of one of my little personal favourites, and their result was okay. We saw about a 20% increase in revenue, which is good, but they had a pretty high PE, so the share price has come back a bit, so we've been aggressively buying that, including for myself. Sarah, we've bought some realestate.com yesterday because she's a mad Dornbusch download viewer, of course. But no, we quite like that business. It's a poor dividend yield. Interestingly, a couple of those acquisitions, that MyFund acquisition, which is sort of the Chinese portal into buying in Australia, sales have increased from $900,000 to $6 million over sort of the last 3 months. So they've started to see a big take-off there. One of the interesting points, though, was they saw an 11% drop-off in listings due to the election. So hopefully now that that uncertainty has passed, albeit with a slim majority, that uncertainty has passed, we should see them start to pick back up again. So certainly realestate.com under $60, I personally think looks pretty appealing.
And I guess just on the .coms, carsales.com brought their numbers out, and again, good numbers, $109 million profit, I think, which was up a bit again from last year. And again, the outlook looks continuingly solid. They mentioned that the likes of free listers like Gumtree and the like, and they basically said there's no real sort of concern for them there. So, but again, just proving that the world's an evolving place, and this internet thing that we've that's well and truly amongst us now just continues to sort of swallow up market share.
I was in a meeting yesterday with a couple of fund managers, and they were talking about how internally they're valuing Domain, which is in essence Fairfax's real estate business, valued at more than the entire Fairfax business itself. And again, coming back to our business, our stock exchange conversation, the name's up on the wall. Fairfax in the late 80s, early 90s was like creme la creme, like you couldn't get a more blue chip shares than Fairfax. Fast forward 30 years, obviously there's been some family infighting and all that type of stuff, but overlay that with disruption from the internet, and it's amazing how quickly the mighty can fall. And on that upbeat note, till next week.
Thank you.